Look guys, we said that at the end of an uptrend, we're looking for a shooting star, and at the end of a downtrend, we're looking for a hammer. We said either it appears exactly as you see it in the chart. We see the hammer in the form of a hammer, or the shooting star, which is basically an inverted hammer. Or, using the combination of candlesticks we've learned, whether it's 2 candlesticks or more, we can identify them. We need to train our eyes to see the market with these 2 candlesticks at the end of trends. Look here, I've taken a section from 4 different spots. Let's see what the end of each rise and fall looks like. Guys, look at this part. These 2 candlesticks. The first one is a bearish candlestick. It opens high and closes low. The second one is a bullish candlestick. A bullish candlestick. It opens low and closes high. This one goes downward and this one goes upward. Now we want to combine the two together. As you can see, we are at the end of a downtrend, right? So what happens when we combine these two? The open of the first one was like this, and the close of the second one forms our body. Guys, when the open is low and the close is high, it means the body is bullish. The lower part here is the low. The highest points, well, as we saw, its shape became a hammer. Guys, when you see a hammer, look, see what kind of reaction it had again, and an uptrend formed, which was because of the appearance of a hammer. Now, where do we go? We come here, look again. This drop happened, these 2 candles again. One bearish candle, one bullish candle. The open of the first, the close of the second. Look guys, all of this combined here formed a hammer, and after that we had such a nice profit. Again, in this case, the hammer itself would have been better if its body was smaller, but we had a rule. We said a hammer is really good when its body is 1/3 the size of its shadow at the bottom, right? That is more than 2 or 3 times what we see from the price movement in this candle. If the shadow is long and the body is much smaller compared to the shadow, it would have been much better here if our body was smaller. But if we pay attention to the size of the shadow, we see that the body is twice as big as the shadow. It can be considered as a hammer in every method, but one of the points that makes the hammer much stronger is this. Having a bullish body, meaning the open is at the bottom and the close is at the top. This was one of the criteria we mentioned in the section where we talked about the hammer. It can also have a bearish body, meaning the shadow is long and the body is small. We consider it a hammer, but a hammer is stronger when its body is also in the bullish direction. Now here we see a bullish candle with a white body. It would have been better if this body was white. Be sure that after that, we will see a larger volume of price moving upward. Now, on this same chart, we have looked at a few examples in the form of a hammer. Look, maybe this itself is a hammer. Here we have a hammer. Now let's clear these. Shall we look at a few shooting stars together? We said we want to see the shooting star at the end of a downtrend. Look. We said the shooting star forms at the end of an uptrend and indicates the loss of that upward movement and the start of a downtrend. Let's look at it together. Guys, let me first draw the shape of the shooting star here. Let's remember what it looked like. It's just the reverse of the hammer. And here, it's much better if the shooting star candle is bearish. What does that mean? It means the open is high and the close is low. Just like we said for the hammer, it's better if the candle is bullish. Now here, we can see the shooting star itself directly. After an upward move, there's a shooting star and then a decline, right at the end of bullish trends. Having a shooting star is a strong sign of a drop, guys, in these very trends we're looking at. After every upward move, every drop I see here has been accompanied by a shooting star. For example, where? Let's take a look at this. Let's combine these 3 candles together. Do you want to combine these 3 together? The open is the first one. The close of the third one, its body is exactly black. At the highest and lowest points, the low. Here we have a shooting star, and after that, the market drops. The combination of these 3, the open of this first bullish candle, the close of the third candle is higher. Here is the lower shadow, here is the upper shadow, and again, there's a drop. So even if we look at each of these, their combination forms a shooting star. So at the end of a trend, we either see a hammer or a shooting star in the market. Now, if the end of the trend is bullish, guys, can you even combine this many candles together? You can. I'll tell you very simply. If we want to combine this many candles from where the market has gone sideways, do you know what happens when you combine them? I say the open of the first one, the close of the last one. You see the lower shadow is here, the upper shadow is here. You can even combine 10 or 20 candles into a single candle. What does that mean? It means, for example, if you combine 60 1-minute candles together, you're basically creating a 1-hour candle. So, as the number of your candles increases, that's what happens. We're not afraid of combining them, because we know that the market itself, with the time frame it uses, is already combining candles. So there's no rule that says it has to be 2 or the last one. It doesn't have to be 3, it doesn't have to be 5. But what usually happens generally in your analysis, when we combine the candles that are placed next to each other and we combine them according to the purpose and clarity we want to have about the chart, we've already talked completely about peaks and valleys. In the PowerPoint, we said that we call it a peak when the close of the next candle is below the low of the previous candle. And we say it becomes a valley when the close of the new candle is above the high of the previous candle. But now we want to see this on the chart. For example, I come to this time frame here, and we want to see here where the peaks and valleys have been confirmed for us. The discussion we had about peaks and valleys, as we said, for example, here the market has dropped and we want to see if this bottom is a valley. Right here, this bullish candle's close is above the high of all of these. It has confirmed that this spot is considered a valley for us. And when it goes up, the highest candle it forms is considered a peak for us. When the close of this black candle falls below the low of the previous candle, it makes this highest point a peak. And likewise, the next valley and the next peak, right? This serves as a formal confirmation for the process of accurately identifying the various peaks and valleys that occur within our price action, ensuring we understand the market's current momentum and overall direction. We want to see if this spot has become a peak or a valley. We know there's a rule that we say there is always a valley after a peak, and after every valley, there is definitely a peak. So, what is something we need to add here about peaks and valleys? It's that we should look at the market in terms of swing highs and swing lows. What are swing highs and swing lows? We generally refer to it as a peak or a valley when, for example, this candle is at the highest point compared to the others in the middle. 2 candles before it are lower on this side and 2 candles on the other side are also lower, meaning for us such a formation is created, and we call this a swing high has been formed. And when here we want to have a low, this is the lowest point of that same candle. 2 before it are higher and 2 after it on this side are also higher. Basically, here we can say a swing low has been formed for us, right? You want this concept to be very simple. So it sticks in our minds, it's very simple. Think of your 5 fingers. The middle finger is bigger than all the others. The 2 on the right are smaller than the middle one, and the 2 on the left are also smaller than the middle one. When this one is at the top, that's a swing high. Now, let's just reverse this. We want to see a swing low. To see this as a swing low, all you have to do is reverse it. When you reverse it, again, the middle candle is the largest and shows the lowest point. The 2 next to it are further back, and the other 2 are higher than this one, again forming that U shape. Here we see it as a swing low, so we can have some swings here, a swing low. So when we say the peaks and valleys should look like this, these are the swing highs and swing lows in a trend that is making a profit. Swing low, swing highs. Again, a higher swing low, a higher swing high. Let's look at the chart using the tools we have at our disposal. With the 5 fingers of each hand, we can always identify these swings so nicely. It's also really easy to remember. Look, guys, I'll show you an example of it here. All right. Take a close look right here, for example. Do you see this specific spot on the chart where that significant price swing has just happened? It is quite clear. And let's say right here, we have it very clearly. We can see these swings. We can easily keep identifying these swings over and over. Now let me erase these. Let me zoom in a bit more, increase the zoom. Of course, we don't actually trade with this level of zoom. I'm just increasing the zoom so we can do what? So we can learn the concepts better. Look, guys, here there could be some swings, but we don't know. If it's higher here before that, we have this one. Could this at this time be a swing? Now, what was our definition of a peak? It's really interesting that we're getting to this point here. We said that this becomes a peak when the close of the next candle is below the low of the previous candle. Guys, here the close of this one is up here, the close of this one is here. None of these closes are below the low of their previous candle. Up until the point where this close came below the previous low, that happened, and the highest point here became the peak. In fact, it made it a swing. In price action, we say swings. If we want to look at it more technically, we're saying the close of the next candle being below the low of the previous candle is what creates a peak or confirms the highest point. So right here, this candle is the highest point, but notice how this close has come down below this low, right? This higher point here has now been confirmed. It can be confirmed right here, or it can be confirmed by the swing candle. But until we get this close, we can't say it's a peak. Why? Because it might continue and go higher, and this event might not happen here. Now, to put this in much simpler terms, what exactly can we say about this pattern? We can say that a clear swing high is being formed right here. This happens specifically when the price action takes on this distinct U shape, or rather, the complete opposite of a standard U. Now let's take a moment to look at this chart together. Do you see this next one appearing on the screen? Right here we can clearly see that this specific U shape has fully formed in the market. Do you see? This U shape has formed. Okay, this U shape has formed. We say that a swing low has been created, but if we want to look at it a bit more closely and technically, guys, this spot here was the lowest point. We said that we only consider this area when the close of the black candle is at the lowest point, right? What about the close of the next candle? It's a white candle. Does its close sit above the high of the black candle or not? It does. So this confirms that this area is valid and this swing has formed here. Now there's also an example. Just like before, it's not always necessary for the next candle's close to be above the high of the lowest point. It's possible for the following candles to also confirm that this is a peak or a trough. Remember, it's right here. Look here, the highest point was here for it to become a peak, and it did become a peak. This close wasn't below this low, and these closes didn't help either, but this close ended up below this candle. The low of this candle, however, confirmed the highest point. There's a resistance here. Then the very next candle comes and its close is above the high of the previous candle, confirming it right at that moment. Pay attention to this. So it's not always necessary to compare the next candle to the one that saw the lowest or highest point. Or in the following candles, we might want the close to be compared to its low, not to the previous candle. Any of these could have confirmed that this top becomes a peak. Or if this one didn't confirm it here, the next candles could have given us this confirmation compared to their own previous ones. Now, it's a good idea to move on to trends. In PowerPoint, we talked about 3 types of trends. We said one of the trends is upward, one is downward, and one is neutral. Now let's go into MetaTrader and see what these trends look like on the chart. Right here on this part of the chart where we're standing, we're seeing this topic, guys, here. Take a look. In this particular section, we can clearly observe a very strong upward trend. You can easily see that the price has steadily moved up in a consistent upward direction. In this section, we are witnessing a ranging trend in the market. Do you remember when we sat down and talked about the concept of market trends? Let's think about what that actually means in practice. For instance, when we look at an upward trend, what are we really seeing? If we identify this specific point as the low and this other point over here as the high, do you recall what the fundamental rule was for defining a true upward trend? We discussed that every upward trend follows a very specific rule. We say that it must consistently form a series of higher highs and higher lows. The next low after the low and high should be a higher low. What does that mean? It means it should be higher than the previous low and the next high should be a higher high. This next peak should be significantly higher than the previous peak. Again, we are looking for a high, a higher high, a low, and a higher low, and so on. As long as this specific rule holds true and this fundamental law of the market remains in full effect. Yeah. we can clearly see that the upward trend is continuing exactly as we expected. That is, it keeps making a higher peak and a higher trough, so the trend remains upward, as we can see here. As we said together, let's clarify one low and one high from these. Look here, one low, one high, one low, one high. So in essence, what we are seeing here is a higher high followed by a higher low. Then again, we see a higher low, another higher high, and a higher low. You see, there is a higher high, then once again a higher low, and finally another higher high. So far, in this trend, there hasn't been any lower low, and the highs keep going higher, and the lows are also moving higher. All right, looking closely at the chart here, we have this very clear upward trend established. Right here is a low, then here is a high, followed by a higher low and a higher high, so it is a confirmed uptrend. Moving along, we see again a higher low, another higher high, and yet again a higher low, and right here too, we observe a higher high. Now, where exactly does the chart give us a signal of a potential change? It happens exactly here, at the moment when it formed a lower high for the first time. And if the price action takes back this specific low, which was our previous higher low in the sequence, we can see that this breakdown happened right in this candle. It's forming a lower low for us, and this part's uptrend is turning into a downtrend. It keeps making lower highs and lower lows like this. Where does it want to reverse again? It has to break this rule. For example, consider a scenario where a significant trend line breaks, or perhaps when we want to discuss a specific movement within this market context. That is exactly when we use this particular term. If we imagine we have a clear trend line drawn right here on the chart. Right now, what exactly are we observing as we look at the price action on this trend? We are seeing these same consistent lows and highs, specifically a series of higher highs and higher lows that define the momentum. These patterns of lows and highs just keep happening over and over again as the price moves up. This continues all the way up to a specific point where the behavior changes. Now let me take a moment to show that to you more clearly using the black color for better visibility. A new market high forms on the chart that is significantly lower than the previous high, and it subsequently breaks down below the previous low, effectively creating a new lower low. This is the point where, as you can see, we had a trend line here. This area is actually the trend line zone. It has exactly made a lower high and then broken this low. And from this point onward, for example, that pullback we talked about becomes lower high, then lower low, lower high, lower low, and so on. It has lost a trend and experienced a breakout. This happens when the trend structure is completely broken. In other words, when we are in an uptrend. Higher highs, higher lows. When a high becomes lower and breaks the previous low. In other words, a swing low that is lower than the previous swings, and it forms a new swing low. When it breaks through those levels, that's when the market changes its trend. These are examples of uptrends, downtrends, and sideways trends on the chart itself. Now here, we've come to talk about the trend line, just like we showed in the PowerPoint. We said that to draw a trend line, you need to give it a range, and then you can turn it into a channel and set your expectations accordingly. You can expect the price to move within this channel, and after that, we talked about breakouts and pullbacks. We've discussed all these topics and now we want to see them on our chart.